Hey, it's Ken Finnan at Capital Advantage Tutoring. It's my job to get you through the exam. I've done chapters 1 through 4 complete for the SIE. This is what we're talking about. I've already done the beginning of chapter 5, which is bonds, and now I'm getting into the third part, which is corporate bonds. So corporate bonds, when you think corporate, think the word non-exempt, think issued by a corporation, okay? So when they're issued by a corporation, there's kind of two choices. They're either secured, which they're backed by something, which means if the company defaults, they sell those things and to help pay you off. And then there's unsecured, which are debentures. But secured bonds are like a mortgage bond. Don't think mortgage-backed security. Mortgage bonds are bonds that are backed by real estate. So if I'm a company, I issue a bond, I put the real estate on the back of it. If I default, we sell the trustee sells the property to pay off the bondholders. That's a mortgage bond. An equipment bond, equipment trust certificate. Instead of using real estate, we use like things like tractors, trains, planes, stuff like that, equipment. And then a collateral trust bond is the same thing, but it's using like a portfolio of other companies. So if I'm GE, I probably own shares of a bunch of different companies. So I'm going to use that portfolio as collateral against me defaulting. So those are safer than unsecured bonds. Okay, we also have asset-backed securities, which is there's different ways. There's CMOs, CDOs, stuff like that, the versions of them. But asset-backed securities are usually loans by banks or financial institutions, and you're buying the stream of loan of the payments people making money. That's in a later chapter, should be in there. But asset-backed securities are not like regular bonds. They're backed by like a loan or something like that. Okay, so we also have unsecured bonds. Unsecured bonds are not backed by anything other than the promise to pay. Sometimes they're called full faith and credit bonds. And in order of liquidation, they come after secured. So it would go wages, then taxes, secured, which we talked about, unsecured. And then below that, we have subordinated debentures or unsecured. Debentures and unsecured are the same word, okay? We have regular and then subordinated, which means below. And then you have like subordinate, then we have preferred, and then we have common. So that's the order of liquidation: wages and taxes, secured, general, which is unsecured, then subordinated unsecured. So it goes, let's do it this way: wages, taxes, secured, unsecured, preferred, and common. Just remember, if you see the word subordinated, it comes after something else, okay? So a lot of times under the unsecured, there are like more the high yield ones. Like if I'm not a strong company that's below investment grade, which means it's below triple B, I'm high yield or junk, which means I have to pay you more for the risk you're taking. Remember, the worse credit rating I have, the more risk the investor has, so I have to pay that. So the coupon will be higher. We also have guaranteed bonds. These are both considered unsecured. A guaranteed bond would be if I'm a smaller company, I issue a bond, unsecured, but maybe I don't have the greatest credit rating in the world, so I have my parent company guarantor. Kind of like when you go to buy a car for the first time, you have your parents co-sign if they can. That kind of thing, or your apartment, they co-sign. They're guarantoring it, meaning just that if you don't pay, the company will pay. It's still unsecured, so it's still riskier than a secured bond, but it is. Now, a couple of things. One, income bond. If you hear somebody say they want income bond is never the freaking answer, okay? Income bonds are bad. They're basically issued by companies coming out of bankruptcy, and what they do is they reorg the bond that they've already issued, and it only pays if the company has income in that quarter. So the problem is if they don't have any money coming in, boom, they're not paying. So income bonds are super risky. We'll go more into it when we cover the top off in the 7, but it's not much more because you just don't freaking use them. Okay, so then we have Eurodollar bonds. Eurodollar bonds are bonds that are issued that basically like a United States company issues it in another country like London, or London's not a country, United Kingdom. And the people who buy it there live in London or United Kingdom. I'll do that for the rest of my life. But it pays in dollars. So a Eurodollar bond is a U.S. company, most likely, issuing a bond in another country, but that bond pays in U.S. currency, even though it's in another country. A Yankee bond is a bond from another country issued here, but it pays in dollars because it's always in dollars. A Euro bond, remember, Eurodollar is issued in another country, paid in dollars. A Euro bond is very similar, but there's no US. It's like if a Japanese company issued a bond in Germany, but it paid in yen. So Eurobond is a Japanese company, could be any company, issuing a bond in another country, but it pays in theirs, but it's not the US. Okay. So now money markets, they're super safe. What we need to know for them, they're super safe debt securities that have a maturity of less than 1 year. Okay. So a debt that's under 1 year is a money market. Anything over that is called funded debt. It's just a name they use. So under a year or less is a money market. Over a year is going to be funded debt. Okay. So now types of money markets. We have commercial paper, which is a short term. So basically it's a corporation. Remember, commercial corporation. A corporation issues a bond at like 980, 990, whatever it is. And then in 9 months, it pays back the 1,000. So it's a very 270-day thing. Since it's so short, it doesn't have to register the Act of 33. So it's a quick hitter. It's when a company needs money on a short-term basis. Okay, a banker's acceptance, just got to know that it's short-term. It finances foreign trade. Later in the top off, we'll go heavier into it. But right now, the banker's acceptance is a short-term. They help with foreign trade between the US and Japan or US and Germany. It smooths out the money flow. Negotiable CDs are CDs, like what you invest in a bank, but you can sell it back to the bank or whatever it is without having to pay a penalty. That's why Fed funds, that's that overnight rate between banks. Money market mutual funds, those are just mutual funds that invest in money markets. And repos are what the Federal Reserve buys and sells from the other banks. Kind of just went really fast for them. So then we have long-term CDs. Now remember, so most CDs, if they're negotiable, they might be a money market. If they're over a year, they're not a money market. Okay, so if you have a long-term CD, it's not technically a money market. Okay, so now this is the way there's a whole chart here for this, so I do it this way. Remember, there are 7 things that don't pay tax on every level. Everything but these 7 you pay tax on: state, local, and federal. Bills, notes, bonds, tips, and strips. Bills, notes, bonds, tips, and strips pay federal, but not state. GOs and revenues are all munis in general. GOs and revenues, or all munis, pay state, but not federal. But if you buy it in your own state, you don't have to pay federal. Okay, so that's chapter 5. Please like and subscribe. Tell people about this. Share it. I'm trying to give back a little bit. And please like, subscribe, and I will talk to you at another time.